In 1929, the world ignored the warning signs until it was too late. Today, nearly a century later, the same signals are flashing again, louder, faster, and far more dangerous. The warning signs are back, almost identical to those that appeared before the 1929 crash. But this time, almost no one is paying attention. In 1929, the world was convinced that prosperity would last forever, that new technology guaranteed infinite growth, and that the stock market would never fall. Today, in 2025, the same dangerous confidence is everywhere. Markets are hitting record highs. Investors are celebrating AI like it's a miracle cure for the economy, and ordinary people are once again being told that nothing can go wrong. But history has a way of repeating itself, especially when people refuse to learn from it. This video digs into the eerie parallels between the Great Depression and the world we're reliving in right now. From inflated bubbles and extreme leverage to central bank mistakes and rising inequality, and reveals why the signs of another crash are becoming impossible to ignore. The goal isn't to scare you, but to open your eyes to the patterns that most people miss. Because the truth is simple. Collapses never come out of nowhere. They build quietly, slowly, then strike when confidence is at its peak. And if we don't understand how it happened in 1929, we won't see it coming in 2025. The Roaring '20s versus the tech boom. The 1920s were a decade of excitement, new inventions, and a belief that technology would permanently transform the economy. People thought radios, automobiles, and mass production meant endless prosperity. Today, AI, automation, and tech stocks create the exact same feeling. Investors believe the future is guaranteed, and companies with no real profits are receiving sky-high valuations simply because they're connected to it. Inboteras optimism created a bubble where people ignored risks, warning signs, and basic financial logic. The Roaring '20s feeling has returned, only now it exists on a global scale, magnified by digital markets. Margin trading then versus leverage today. In 1929, people were buying stocks with money they didn't have. Margin accounts allowed investors to borrow up to 90% of a stock's price. When the market dropped, everything crashed at once. Today, leverage has taken a new form. Crypto margin trading, option contracts, by -now-pay, -later consumption, and massive corporate debt. Consumers use credit cards for everyday essentials, while big companies borrow endlessly to buy back their own shares. The entire system is built on borrowed money. Just like in 1929, leverage creates artificial confidence. And when markets turn, leveraged positions collapse faster than anyone expects. The Federal Reserve's critical mistakes. In the late 1920s, the Federal Reserve tightened monetary policy at the worst possible time, raising interest rates just as the economy was slowing. Their attempt to cool speculation helped trigger a complete financial meltdown. Today, the Fed has repeated that pattern. Aggressive rate hikes through 2023 and 2024. Even as inflation cooled and consumer spending weakened, high rates are crushing housing, destroying small businesses, and straining global markets. Liquidity is shrinking, banks are stressed, and borrowing costs are suffocating households. Once again, the central bank believes it can control the outcome. But history shows otherwise. Wealth gap exploding. The 1920s saw extreme wealth concentration. The top 1% earned a massive share of national income, while ordinary workers struggled with stagnant wages. This imbalance made the economy fragile, because when the working class can't spend, demand collapses. Today, the wealth gap is even larger. Billionaires multiply their fortunes through rising asset prices, while the average family battles inflation, rising rents, and shrinking savings. When the vast majority of people live paycheck to paycheck, even small economic shocks become system-wide disasters. An economy cannot survive long-term when prosperity is built on the success of a tiny elite. Banking instability hidden beneath the surface. Before the 1929 crash, banks were quietly weakening. Many held risky loans, bad assets, and lacked liquidity. When panic hit, they failed rapidly. Today, we're seeing similar cracks. Regional banks are burdened with collapsing commercial real estate loans. Deposits are fleeing to bigger institutions, and liquidity is drying up. Tech startups are struggling to raise capital, mortgage defaults are rising, and corporate bankruptcies are accelerating. Yet the public remains calm, just as they did in 1929. Modern banks may look stronger, but vulnerabilities are hiding behind complex financial products that can unravel quickly under pressure. Overproduction then, versus overvaluation now, in the late 1920s. Companies overproduced goods because they believed demand would never fall. When consumption slowed, inventories piled up, profits dropped, and panic began. Today, we don't have an overproduction of physical goods. We have an overproduction of financial assets. The market is flooded with ETFs, derivatives, SPACs, AI-driven trading products, and synthetic assets that inflate valuations. Beyond reality, companies are priced for perfection even though earnings don't justify it. Just like factories in 1929, the financial system is producing far more value on paper than the real economy can support. Global fragility in 1929. The crash spread worldwide because major economies were deeply interconnected. Today, global links are even more sensitive. China faces a property crisis. Europe is battling recession. Supply chains are fragile, and geopolitical tensions are escalating. A shock in one country no longer stays contained. It ripples instantly through global markets. With debt levels at historic highs in almost every nation, even a small financial disturbance can trigger a chain reaction. The world economy is balanced on a knife's edge, and one unexpected event could create a collapse far larger than the one experienced nearly a century ago. Why 2025 could be even worse? The parallels with 1929 are alarming, but the risks today are much greater. Global debt is at record highs. Central banks have less room to intervene, and technology-driven markets move faster than humans can react. AI trading can accelerate sell-offs. Corporate debt cliffs threaten major firms, and consumer savings are nearly exhausted. A single trigger, a bank failure, a geopolitical shock, or a sudden market correction could ignite a downward spiral. This collapse may not look like 1929, but it could be deeper and more systemic. The foundations of the modern economy are far more fragile than people believe. In the end, the warnings are not hidden. They're simply ignored, just like they were in 1929. The bubbles, the leverage, the fragile banks, the global tensions. All of it forms the same dangerous pattern. But a crash isn't destiny. It's a consequence of choices, blindness, and misplaced confidence. The real advantage belongs to those who study history, who recognize the signals before everyone else, and who prepare instead of hoping the storm will pass. As we move deeper into 2025, remember these markets don't collapse when things look weak. They collapse when everyone believes nothing can go wrong. Stay informed, stay alert, and never underestimate the lessons the past is trying to teach us.